Hi, my name is Amin and I'm a financial controller, and in today's video we'll be discussing one of the most used valuation methods in order to evaluate a company or business and define if the share value in the stock market is over or underevaluated. I'm of course talking about the discounted cash flow, commonly called the DCF. There are other valuation methods like the market capitalization, liquidity value, or the book value, but all of this will be subject to future video. So let's, in this video, just focus on the DCF. We will first of all look at the different steps that we need to go through in the DCF method. So first of all, we need to forecast our free cash flow. Then we calculate the weighted average cost of capital. Third, we calculate the terminal value. Then we discount both the free cash flow and the terminal value to the present. And finally, we perform the valuation. So let's start with the free cash flow. What is exactly the free cash flow? It's basically the earning before interest and tax, to which we deduct our tax rate. Then we add our depreciation and amortization. And then we deduct any capital expenses or investments. Then we deduct the increase in net working capital. What is the net working capital? Is basically current asset minus cash minus current liabilities. So why we're deducting here the increase in net working capital? The two drivers that would have an increase of the net working capital is either an increase in the current assets or a decrease in current liabilities. So if you look in both cases, this would mean a disbursement in cash. So in fact, either we disperse cash to buy new current assets or to reimburse liabilities. Hence, we have a deduction of the increase in the net working capital. Now, let's move to our example in the Excel file. So as you can see, we take historical data, usually 3 prior years. Those will help us to define the trends of sales as well as our margin. Usually, to calculate our forecast, we need to understand the company's business model, the industry it operates in, the competition framework, and the macroeconomic conditions. Once all of these are defined, we then start our revenue and expense projection. The projection is usually done over 5 years. It's not necessarily a rule, but this is what usually is done, as it strikes a balance between providing enough visibility into the future cash flows and reducing the uncertainty associated with the long-term forecasts. So, if you look in this example, I have taken an hypothesis of a sales growth rate of 5% in year 1, 5% in year 2, 3% in year 3, and 2% in both 4 and 5. Then we calculate our EBITDA by subtracting operating expenses and cost of goods sold from our sales. Then we deduct amortization and depreciation to get our earning before interest and tax, to which we deduct our taxes to get finally the net operating profit after tax. Bear in mind that since amortization and depreciation are not really cash disbursement, we need to add them back to our net operating profit and tax in order to determine our real cash movement. We then deduct any capital expenses for investment, and we add or we deduct any net working capital variation. Bear in mind that any increase in net working capital would be a minus, and any decrease would be a plus. Then we define our free cash flow. Now, the next step that we have our free cash flow is to define our weighted average cost of capital. In fact, the WACC is the appropriate discount rate that we apply to future cash flows to get our present value. So basically, what is the WACC? Is a weighted average of cost of debt and cost of equity. So basically, if you look in here, the cost of debt, which is here, it's basically the interest on a loan that we might have after we deduct the tax. So it's net of tax. And this would be our ratio of debt out of debt plus equity, to which we add the cost of equity, also called the capital asset pricing model, and this basically would be this one. So this is the formula that says for the capital asset pricing model is we would have the risk-free rate plus the beta, which is the sensitivity, or also called the volatility of the market. Here we have the expected return of the market minus the risk-free rate. So now let's have a look at our example. So here we calculate our capital asset pricing model by, I've added the formulas here. So with those figures are a proper assumption just to help us actually to calculate our WACC. So here we have the risk-free rates, to which we add our beta times market rate minus the risk-free rates. Here we need to calculate our ratio of equity out of debt plus equity. So here we have plus our debt value, and here we have our debt value by equity value plus the debt value. So this will give us a weighted average cost of capital of 8.5%. So now that we have both our free cash flow forecasted and the WACC, we need to calculate our terminal value. So basically this is the formula of the terminal value, and as you can see in the DCF, actually it's based on all the future free cash flow that the company will raise or generate during its whole life cycle, discounted at the rate R, often is the WACC, to get the value of the present value. So, as you know, it's quite difficult to calculate this until the infinite. So what we do, there are a few ways to calculate or determine our terminal value. So we have first approach or method. It's called the perpetuity growth method, or also the Gordon growth method, is the preferred method for scholars and academics, as it's backed with math theory. In fact, it assumes that the company will continue to grow at a constant rate, and then the return on capital will exceed the cost of capital. Hence, this would actually be applied for mature companies with a stable growth rate. So basically, the formula would be, we take the free cash flow at the N year, which is the last period of the forecast. In our case, is 5 years, times 1 plus the growth rate, divided by the WACC minus the growth rate. The other approach, it's called the exit multiple approach. And this assumes that the business will be sold or valued at the end of the forecast period based on a multiple of some financial metrics. We usually use the EBITDA or the EBIT, and to which we actually multiply it on a currently observed comparable trade-in multiple for similar firms in the industry. So if you look here, we have the terminal value would be the metric EBITDA times multiplier. And for our example, we take the multiple example. Here we take enterprise value divided by EBITDA. The other metrics that might be used are the EBIT, the price to earning multiple, the market to book, and the price to revenue. So if we take now all this in our example, so here we have our weighted average cost of capital that we've calculated before. We presume that we have a growth rate of 2% and our multiple of 11. So here we see all the figures that we've calculated earlier in our forecast. So we have our EBITDA and free cash flow. So let's calculate the terminal value according to the perpetuity growth method. So here we have our free cash flow in the last year of forecast times 1 plus the growth rate divided by the WACC minus the growth rate. Sorry, because I haven't put brackets. Then we calculate the terminal value based on the exit multiple approach. So we have our metric EBITDA. We take the same thing at the end of the last year times the multiple, which gives us the 10,374. So in other cases, some practitioners, instead of taking either the perpetuity or the exit multiple, we will take an average of the two. But as you can see, the figures are almost the same, and they should be. So once we have our terminal value defined, then we go to the next step, which is to discount our free cash flow to the present, as well as the terminal value. So here, if I take the example in here, we have our WACC, that would be our discounted rate. We have our free cash flow that was calculated earlier, and we have the terminal value that we've just calculated. Then we need to calculate our discount factor, and basically the discount factor, here's the formula, which means 1 divided by 1 plus the WACC raised to the power of n. So here, for example, would be 1 divided by 1 plus 8.5 raised to the power of 1, and so on and so forth. Once we have this, then we actually calculate our present value for the free cash flow. So we just basically have the free cash flow times the discount factor. I copy this cell and paste in here, and this one would be our terminal value times our discount factor. This would be a sum of both the present value of our free cash flow and present value of terminal value. So that means our company, or our enterprise value, is 9,701. Now that the steps of discounting is done, we need to go to the next step, which is to go from the enterprise value to our equity value. So as you can see here, the enterprise value, it's basically would be our net debt and equity value. And our equity value is our enterprise value minus total debt plus cash and cash equivalent, where the enterprise value would be market value of equity plus total debt plus minority interest plus preferred stock minus cash and cash equivalent. And our total debt will be our short-term debt plus long-term debt, and cash and cash equivalent would be our cash on hand plus marketable securities. So if we go back to our example here, so we get our enterprise value from what we've calculated earlier. Our cash and cash equivalent, it's an exception. Same here for debt and debt equivalent. So by calculating this, basically we're taking our enterprise value plus our cash and cash equivalent and minus our debt and debt equivalent. This would give us an equity value of 10,331. If we presume that the company has 400 shares outstanding, then we just basically divide our equity value by the number of shares. Then we get our price per share of $25.83. Here we come to the end of this DCF method. Please, if you have any question or comment, leave it in the comment section. I hope you enjoyed this video, and let me know if you have any suggestion for the next video or how to make these videos better. And till the next time, I hope you take care of yourself and stay safe. Thank you.